Welcome back to Real Estate Mindset. I have a great guest of honor here today, very brilliant investor, especially in commercial real estate, Orlando Minor. How are you today, sir?
I'm doing great, man. I appreciate you letting me come onto your platform. Boy, we doing collabs, and more collabs.
You know what, man? I really value your perspective. A lot of people don't know, how well you know the housing market and the commercial housing market, especially. And obviously, Orlando, as more time goes on, you're going to be seeing a lot more distress in the market, especially being that you're a commercial lender, basically. And guys, if you want more perspective from Orlando, please go to his channel. You probably already know what it is, but it is Orlando Minor on YouTube. He's got some incredible stuff, incredible insights. And Orlando, thanks for joining us today. I know your time, you don't have too much time today. I know that you've been getting a lot of calls for, in the commercial
it's been pretty busy,
industry.
It's been a busy year. And as you know, commercial and all this other stuff is, moving around, moving, shaking, just real estate in general. So, yeah, man, always can make time, bro. Always.
I appreciate that, man. I know how busy you are. But, I want to start by talking about, kind of the last time we talked, one of the first questions I asked you, Orlando, is, what was your definition of a housing market crash? And we kind of broadly, explained it as you said, something like 15% price decline. And since we've done that video, I kept thinking about the fact that we've already had metro areas that have had 15% price decline. I started digging even more, and I actually found metro areas that have, a lower value than January of 2020, being San Francisco, Birmingham, Alabama. New Orleans is close. New Orleans had a massive run up from December to January in median sales price. But they've basically wiped away all of the gains through COVID. Now, some of them had inventory, and I want to ask your opinion on inventory here in a minute. But I wanted to start by asking, do you think it's possible, because of the magnitude of the equity run up in the short amount of time, do you think it's possible that, let me ask you, do you still think 15% would constitute a housing crash, a 15% nationwide average in price decline?
I mean, I still stand on that. I still believe 15%. And once again, it's 15% nationwide, right? Like, obviously, if we go to Austin or Boise or San Francisco, you start to see certain cities hit that 15% mark. And I really want to stress this, that a lot of these areas, that, especially the ones that you just named off, or the ones that I just named off, they had huge, massive run-ups. A lot of people were moving from state to state and city to city. And so things like that, those prices got pushed up pretty high. So that 15% drop that we're seeing are some drops where they're even a little bit, they're cheaper than pre-pandemic. So yeah, I still stand on that 15%.
Okay. All right. Good to know, man. Because, I'm thinking, Orlando, I'm like, people can't even feel that 15% in these metro areas. But like you said, it was just the massive equity run up. So I want to go to the next thing.
Before you jump in, I just want to add one thing to that, is that, again, it's a nationwide thing, right?
Yes.
Like, if city to city, it's just going to be vastly different. But I believe, this is just obviously my opinion, that if you see a 15% across nationwide, it's going to hurt the economy. It's going to hurt all types of unemployment, all these things. You're going to see a domino effect nationwide. And I think all of those dominoes will start to, hit each other if we were to nationwide hit that 15%.
Yeah. And I would agree with that. And honestly, Orlando, right now, the housing market is greatly splintered. There are some areas that are still going up in value. And so I personally believe the primary reason that is it's so splintered deeply like that is we haven't gone into a full-blown recession. I think that full-blown recession, it does spread, more nationwide, which brings me to my next question. I've heard a lot of people say, oh, you've kicked the goalpost or whatever. Although, I would argue the deficit spending from the government, exceeding the M2 money supply, that's kind of, probably kicking that ball down. Anyways, moving the goalpost, kicking the can down the road. But anyways, what it means to say is recession. Okay, recession. Right. We always talk about recession. Can you explain to the viewers your opinion of what changes during a recession? Why do we keep saying that once the recession happens, prices will go down per se. What changes during the recession, Orlando?
Well, to me, it's fairly easy. What changes in a recession is people's ability to spend and get what they want, however they want, when they want it. All of those things start to claw back. You see things like you start seeing slowdown in almost every factor. It could be restaurant, going out, traveling. All of these things pull back. That is the reason. This is the reason why that the definition was 2 consecutive GDP, right? Going down. And then we saw, a couple of years ago that the government changed that definition, and then they re-brought it back, and it keeps moving around. So when individuals say, the changing of the goalposts or moving the goalposts, the real thing is that the government themselves are moving the goalposts. And here's another thing that a lot of people don't understand. A lot of times after we've already went through the recession, after we've had a downturn in traveling, a downturn in spending, people's income not going up. Once that has happened, a couple years later, you'll get a report from the agency that really determines if we're in a recession. And that's when they determine we're in a recession. It's normally a 2-year period after it, and then they go, yep. When we look back, yes, that was a recession. So a lot of times what I tell individuals is that, yes, we do have, quote unquote, a definition, a technical definition, no matter if it's been changed or not. But what I really want people to understand is, what about what you see in front of your eyes? We have to understand this bubble that we're in. We have to understand that if you go to the grocery store and you see regular products, meat, chicken, beef, all of those things going up by triple, double, right? If you see all of those things going, you should understand that there's something going on here. When you have to spend double the amount of money in a grocery store to get less than you did a year ago, then there's probably something going on in the economy. So I tell people to believe their eyes, believe their pocketbooks. That's what you need to believe.
And Orlando, but still though, for what we're saying, why is a recession so important, an important part of the equation to when we are warning people, explain the pain. What pain comes with the recession? What changes? What comfort changes across the nation, right? Because we see it splintered. We see various house markets, like you say, real estate's already in recession on a residential level. What changes for people at home, right? Main Street. What changes for Main Street?
To me, it's really simple. It's really simple. Income. That's what changes. When job losses happen, when people are losing jobs, when people get downgraded from a position to making less money, when expenses exceed the amount of money that people are bringing in for regular everyday needs, things that they really, really need, that's what the recession is. That's the catalyst of it. When people's income dries up, and we're starting to see it right now with the UPS and it was just Netflix, and I just did a video where I was just explaining that Expedia laid off 1,500 people, and they're chipping away at the workforce. When people's income starts to evaporate, that's the recession.
Yeah. Yeah, and that's very, very good. Orlando, that's kind of what it's looking like is the job loss. There's so many people that are living paycheck to paycheck with poor spending habits, whether they choose to have the poor spending habits or the government has forced it upon them through inflation. I mean, certainly through recession and job loss, these people that are handcuffed, golden handcuffed, will now have an incentive, more and more incentive to sell. And the argument has been no one's going to sell. They can't afford to sell. Well, at one hand, you have the rental market, loosening up. You have more inventory, prices going down. So you have an incentive to sell there. But if you lose your job and you have $100,000 in equity, you're going to sell. There is going to be an incentive to sell when a recession hits, when there will be unemployment, in my opinion. But Orlando, next question. How likely we have GDP? Okay, I'm going to report the numbers, the headline numbers. GDP magically in the 3%, ending
Yeah.
last year.
Okay.
Unemployment at 3.7.
Hmm.
There's going to be a soft landing. What is the likelihood, in your opinion, that we even hit a recession?
You said what is the likelihood?
Yeah, how likely do you think
It's
it
pretty
is we go
high.
into
I was.
recession?
I mean, I don't really like to give numbers, but I would easily say that it's above at least 70%. At least 70% chance that we're not going to hit this soft landing. It's my opinion, and I could be wrong. I could be wrong, obviously, but I just don't see a soft landing at all. There's just too many things, and there's too many things that are super high. Like, we could just even, obviously we're talking about housing. We could just talk about housing. Housing itself. How are we going to get housing down? How is housing going to magically come down to where people can afford it? There's only two ways, in my opinion, that people can afford houses at where they are right now. Either people magically get money in their pocket, right? Or housing goes down. Interest rates won't help. In my opinion, interest rates will not help. Matter of fact, I believe if the Fed brings down the interest rates, he puts us in a deeper recession. So there's only in my view, the recession is literally already here. People are already having a very hard time making ends meet. And I'm not just talking about individuals who are not responsible, who don't budget. I'm talking about individuals who are literally budgeting every single hour, every single minute, watching their money, and they still can't make ends meet. Why? Because their income hasn't went up. We know wages haven't moved at all. So if wages haven't moved at all, but everything gets more expensive, eventually, it's something has to pop.
Yeah, and honestly, if we look at the yield curve inversion, specifically the 3 month, over the 10 year, it's 100% likelihood of a recession. You look at the 10 and the 2, I think, I don't know, 80%. I mean, in my opinion, I mean, I don't know how, if it wasn't for deficit spending, I think we've already been in recession. The fact that they're spending, the deficit is increasing as if we already in recession, to me is alarming. So there's that, but also Orlando, you said something, and I was hoping you could kind of dig into this a little bit deeper before we move on to
Yeah.
inventory. You said that you feel like if the Federal Reserve lowers rates, it would create a deeper recession. Why?
Yeah. Well, I think that it's if you go ahead and you lower the interest rates, it's gonna do what it did previously, and we saw that story. And what that does is it's going to push up housing even higher. Not only does it push up housing higher, but it has everything that's associated with housing is going to get pushed higher. That means taxes, that means insurance, that means getting a new roof put on, that means the service industry for housing and branches off of there. Everything that is associated with housing because of the lower interest rates is going to push everything higher. Where does that end? Where does that end? Does that mean that interest rates have to continue to stay low for us to be able to continue to let this thing go? And we know that's never going to happen. We know that's not going to happen. So the Band-Aid has to get ripped off eventually, right? And that's what I'm trying to tell people is that, look, this was due. This isn't something that's like, oh man, we've never seen this happen before. This happens in cycles.
I mean,
and we're due for it. We're very due for it. So to continue to kick the can down the road and for the Fed to go, you know what, to keep this thing going, I'm going to go ahead and drop down to 2 to 3%. That would be catastrophic, because if you think we have a recession is coming up and it's going to be bad now, let them drop the rates and see what happens in 2 to 3, 4, or 5 years after that. It's going to be ridiculous.
To me, Orlando, it seems like the Fed is actually fighting the federal government spending problem. So it's just like you got, quantitative tightening that's hurting the consumers, and then you have the government that's just spending as if we're in lockdowns and printing money still at 0% interest rate policy. So it's just really remarkable how they just keep this thing going. So I want to shift, if I may, to inventory. Now, I mentioned that there are a couple metro areas that are already from a median sales price, and I'm basing this off of Redfin. So if you go to Redfin, you can find this yourself. But San Francisco, when we compare January 2020 to now, is under. It has erased the blowing up of equity, as has Birmingham. Okay. And I also said, New Orleans was close. Now, when I look at the inventory, okay, and then also I want to also mention that from a year over year aspect, Redfin has updated their information today. There's 2 metros on that year over year price decline list, obviously in Texas. I think San Antonio was one, and I believe Austin was on there as well. Now, when I look at inventory, San Antonio peaked, I think the middle part of January, maybe later part of January, at 8 months of inventory. Okay, Austin at 7 months. Birmingham peaked around 7 months as well. New Orleans, Orlando, you ready for this?
Oh yeah,
New Orleans, 9 months, peaked at 9 months. 9 months. They still have in the 30s as far as weeks. New Orleans has so much inventory, it's insane. But San Francisco, okay, which has erased the gains if you look at it, has not quite peaked at 4 months. So not that traditional 6 months. Right. So, which is leading me into my next question to you. How important do you think inventory growth is, and supply being around 6 months, sustained inventory growth and supply being at 6 months? How important do you think that inventory being sustained there is important for prices to go down and more pressure on that price decline?
Well, I mean, it's always great to have more supply, right, than demand, right? That's always going to be a great factor. But do I think it's a factor for prices to come down? I would say no, because if there's no demand, and we know how low the demand is, if there's no demand, there's still going to be people who. Just because there's little to no demand does not mean there's someone out here who doesn't want to sell their home, or that there's a person who doesn't want to purchase a home, right? So you always will have that, right? And so if I put my house up for sale and it's been on the market for 3 to 4 months and I haven't dropped the price, I obviously don't want to sell the home. and what if I have some type of pressure on me, like, oh, my new job, or I got to move somewhere, or I'm moving closer to family, or something like that, right? Once again, my situation isn't everyone's situation. So I think that with low demand that they currently have right now, supply really isn't a huge thing. Not like a lot of these realtors and real estate agents want to make it to be. They're like, hey guys, listen, you better buy right now, because if you don't buy right now, you wait until interest rates drop. And then supply is going to just keep getting smaller and smaller. And since there will be so little houses, then that means that housing will shoot up 40, 50%. Those are what actual realtors are saying. This is what they're saying online. So again, do I think that supply is going to cripple the housing market as far as prices coming down? And I would say no to that.
Well, I mean, certainly migration is very powerful attribute with price movement, whether it's net or growing migration. Certainly, the unaffordability, strangling the locals is But Orlando, wouldn't it be probable that if inventory went up? Say only, for my calculations, all we need is about 200,000 roughly. That's it, 200,000 more active units sustained to put us around 900 to a million. Couldn't it be probable that would actually put pressure on prices going down in addition to those other things, so long as the rates didn't go down and create a massive amount of demand?
Again, I want to be clear on this. I think that having a high supply, it's great. Having high supply, low demand, it always is a plus. It will add to it. It applies pressure on prices going down. I do not deny that, right? And I think that's a great thing. But do I think that the only way that housing prices will come down is if supply gets past 6 months? No, I don't. I don't think that. I think that where we are currently right now, with the low demand that we're having right now, with the high interest rates and everything like that, I think that's applying pressure on the housing market to bring prices down, to make them more affordable. Because at the end of the day, people still have to sell their houses. And when they sell their houses, they want to sell them so that they can make money from them. And you're not going to make money from them if you're selling a house that's overpriced. Not in this market. You could sit around and wait and wait 4 to 5 months to hope that you get a magical seller who will purchase your home for, 40, 50, 60, 100, $200,000 over asking. You can do that. But the likelihood of that happening with the market itself, to me, is low. So I say that so long the demand is low, the supply portion that we're currently at is not the only factor for prices coming down.
Well, yeah, I mean, yeah. Well said. Many factors involved in what's going on in different markets. I mean, your point stands with San Francisco erasing any gains, and they only have 4 months. So, I mean,
exactly.
You have your points. And that's what makes, again, I just go back to, that is how amazing this housing market is, Orlando. And that's why I try to have empathy even for people that make like crazy comments to us, because like some of them are just consumers trying to figure things out. They're resentful. They've given up hope. Sure. Maybe they had a late payment on the credit card, the purchasing power shot. I don't know. But they missed out on an opportunity maybe to purchase in 2020 when rates were low and home prices were still low. I was helping people back then in 2020, 2021. I myself have made offers each of those years, including 2022, 2023. And I may make an offer this weekend because, what I try to teach people is how to find a great deal. The greater the deal, the more, basically the easier it will be to get through a recession. And that's what I want to warn people about. Again, when we look at the yield curves, when we look at other things, deficit spending, when we look at these things, this is not healthy. Do I know what's going to happen next, Orlando? No, but I have been swept up in bad things that I didn't see coming before and lost everything. So I think I have a right to say, y'all, just hold up. And you're not a bad person. I hate the bullying, but let me just end on this question. Do you think, well, you said 70% roughly, I think we enter recession. Recession brings unemployment. Unemployment can incentivize golden handcuff existing home sellers to sell. We still have unaffordability. Do you think all markets will get hit? Will every market have price decline for homes, in your opinion? Being that every market essentially is in a bubble, whether you think it's going to burst or not with viewers is another matter, but it is an asset bubble around the nation. Do you think every market gets hit, or do you think anyone is going to? I
don't know, man. It's tough. Okay? And that's a really tough question, because my initial answer would be no. Right? I don't think 100% of the whole market will just fall off of a cliff, and because it's just, each market is different. And we say this over and over again, that you have to look at your market, and that looking at your market, the market that you're looking to purchase your home, the market that you're in, it's so important. Yeah, the nationwide data is great and all, but if you really focus and hone in on your location, you will really start to see things a lot more clearly of what's happening in your area, rather than using the national data. And so my initial answer would be no. I don't think every single area in the nation is going to see a downturn. But what do I think? What do I know is going to keep those areas up? I don't know. I mean, there's just so many things happening in the world of finance, in the world of the housing market, that could hold things up. I mean, maybe jobs in that area are really, really good, and maybe that city or that town has a job that's insulated from some type of job loss. I don't know what that will be. Maybe that area maybe it didn't jump up as high as far as like a area like my area, which is like the Midwest, right? Where it didn't have that shoot up in appreciation. Mm-hmm. So in reality to the entire nation, we look really affordable. The Midwest does, right? Just nobody wants to live here. That was a joke. But you know what I mean. It's just the prices didn't go up as fast as like the coast do. We all know the coast, East Coast, West Coast, any place with the coast, with the beach and the weather and all that other, the Sun Coast. We all know that. We all know that those prices are going to shoot up higher and higher and higher. And and that's what happened. And so, yeah, the answer is no to that. And I'm just really curious to kind of see how that's going to all play out.
All right, I think that's a reasonable answer. I mean, it is splintered. I mean, recession does hit, but I mean, there's some areas that are different than others, like you mentioned. In Orlando, let's take a break from all of these. I don't want people to be like so worried, like they're paralyzed. I don't think that's why people watch us. I mean, so can we end in some hope here? What would you be doing if you were a normal, everyday consumer on the sidelines and you wanted to buy a house? What would you be doing?
First, I would be getting my credit together. I would be saving for an emergency savings account. I would be so into looking at the houses in the area, how long they have been on the market, what's sold, that's in my area. I would be just so focused on that. But just financially, personally wise, I would just be making sure I did the things that I just said. Make sure your credit, emergency savings account, save your money, make great finance decision, budget, do all of those things. Don't overspend, get rid of debt. We know that's a really big thing. Getting rid of debt. People are exchanging, the money that they used to have in their savings account from the pandemic, and they're now putting that lifestyle over into their credit cards. I just want to get rid of all that mindset thinking. We do not want to take pandemic lifestyle and then put it on a Citi credit card or a Capital One. We do not want to do that. Okay, guys. So that's what I would focus on.
Okay, very good. And, obviously, like you said, becoming experts in your local market, I'll add, Look at subdivision. If you really want to know what's going on, you got to look at subdivision. When we look at Redfin data, it's not going to tell you what's going on in Houston. I'm going to be honest with you. If you really want the intimate details, you have to be able to access the intimate details, which is sales data. And the terms of that sale, whether it's seller concessions, how long was it on the market, price cuts, they go over, under asking. There's so much data that the public doesn't have access to. It's frustrating. And that's why I'm always like, you need great realtors. You need great realtors to report that data back. Some good things there. Other than that, Orlando, I'm going to let you, huh?
I said, where are they?
They're around here and there.
No, I know they're out there. I know they're out there.
Yeah. I don't want to, as a whole, the industry, in my opinion, has completely failed consumers in almost every aspect of due diligence.
Oh, wow. And we see that.
And protect the consumer. People are trying to protect their income. I mean, I understand it. I understand the situation. I'm not making excuses for it, but the reality is we need consumers to have access to the data. We need them to understand how to use that data to make safe purchases. If people want to obsess about the housing market instead of obsessing about buying, they should obsess about how to buy. And in that, I think they're going to be better off. Yes. Now, Orlando, I'm going to let you go. You guys don't forget, show Orlando some love. Go over to his channel, hit like on his channel, hit like on this video as well if you found value. And other than that, we're going to let him get out of here, Orlando. If you're out there investing in real estate, we wish you luck and we hope you win.